The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon, and welcome to the webinar hosted by the IRC Institute and Cornerstone Capital Group on a new report, The Data Privacy Puzzle. Our agenda for the webinar today is as follows. We'll do logistics and introductions of the speakers, an in-depth review of the research. We'll have a few words from the IRC Institute with their perspective on the research findings, and then we'll take your questions. In terms of logistics, all the attendees are in listen-only mode during the webinar. We do encourage your questions, though. You'll see a control panel. You can type in your questions using the question function in the control panel throughout the presentation. Once we run through the research, we will read those questions aloud, and our speakers will respond. We are recording this webinar right now, and a replay will be available later this afternoon on our website. This replay and report are available at www.irrcinstitute.org. We do encourage you to share information on social media about this report if you are so inclined, and you can see our Twitter handles there. If you happen to have any audio issues during the session, please contact GoToWebinar at 1-800-263-6317. We have two speakers today. The first is John Wilson. He is the report author and head of research and corporate governance at Cornerstone Capital Group. John has a wealth of experience, more than 2 decades of experience in sustainable investing and corporate governance. John also is an adjunct assistant professor at Columbia Business School, where he teaches an MBA level class on sustainable investing. Our second speaker is John Lekumnik. He served as the executive director of the IRC Institute since its founding, and with the board of directors, he's led the organization to become a leading source of objective academic and practitioner research on a wide array of investment issues. He also has decades of experience working as an institutional investor, including time as the investment advisor to the New York City pension funds. Just a few words about the IRC Institute if you're not familiar with the organization. It is a nonprofit established in 2005, and the organization funds and disseminates unbiased research on a whole range of issues at the intersection of corporate responsibility and the informational needs of investors. As I mentioned before, it's both academic and practitioner research. We host an annual research award with 2 $10,000 awards. The deadline is coming up soon, October 19th, 2018. You just go to our website and you can find out more information on how to submit research there. Also on the website, you'll see that there's more than 75 research reports available at no charge. Just one other note, you may have seen our news last month that the IRC Institute has selected the John Weinberg Center for Corporate Governance at the University of Delaware as our successor organization. The Weinberg Center will receive a grant from IRC Institute to expand its environmental, social, corporate governance, and capital markets research, and also maintain this full library of research on the IRC website at no cost. The Weinberg Center also will continue to fund and manage the IRC Research Award. And with that, I'll turn the presentation over to John, and he can tell you a little bit about Cornerstone and then dive right into the research. John?
Thanks very much, Kelly, and thanks everyone for coming today, and also thank you to the IRC Institute for their support for this research. Just a little bit about Cornerstone. We are an investment advisory firm. We were founded in 2013. At this point, we have just a little bit over $1 billion under management. We help our clients invest in a manner that is both prudent and sustainable, and all of our clients expect that their investments will meet their financial goals, but also will be consistent with their values and their goals for impact. And so we make that possible really through a commitment to giving good advice and doing very rigorous research on topics related to ESG. And so that's what brings us here today. The goal of my discussion today really is to talk about our report, The Data Privacy Puzzle. And the report basically does 3 things. First, we talk about the trends that are in society that are leading to an increased concern around data privacy as an investment issue. Second, I'll talk a little bit about our framework for understanding the investor implications of data privacy, and especially as it progresses over the coming years. And then talk a little bit about our assessment of companies. And I will say right at the outset, we are not making any recommendations about investment in any companies or to not invest, but just to talk a little bit about one issue and the implications that you might want to think about in your investment and your engagement decisions. So the first thing I want to do is go through the trends that we see as being relevant for this issue. And so Gus, going to this slide, basically, and before I start on this slide, I just want to point out that we pulled all the graphics from the report itself. And so when you see figure 3, that's not because you missed figure 1 and figure 2. That is figure 3 in the report, not the presentation. So just a clarification there. We have been living through an explosion of data really for the past 10 years or so. There's been exponential increases in the amount of personal data being collected on individuals, families, businesses around the world, and that's been happening for many years. What's changing now really is the nature of that data and the nature of our connection to it. The first is that we are more and more of the data is being collected what we call passively, meaning without the user or the individual actually voluntarily giving up that data. And that's happening through more and more interactions with connected devices. So think about how your phone records where you are as a way of analyzing traffic data. That would be one example, but there are more and more of those examples coming. Some of the apps on your phone will themselves track your whereabouts. Your washer and dryer and your air conditioner are starting to send data about your activities off to the companies, and more of these interactions with the devices that we live with will be so-called connected interactions, meaning that they will be generating data about us. And so figure 3 here shows that as of about 2020, we're going to be seeing an explosion in this kind of interaction. So, we'll go from, excuse me, less than 1,000 up to about 5,000 over the next 5 years. So the interactions with the daily devices that we interact with in our daily lives are going to increase exponentially. And the second thing that we need to be aware of is that the importance of data will grow. So we're talking here about data that is relevant for the decisions that we make in our lives. That's critical data, or else hypercritical data, which is important for life or safety. So healthcare data, driving, safety data, those kinds of things are hypercritical, and that will eventually be 20% and 10% respectively, again, within the next 5 to 10 years. So the data will become much more important to our lives, even as more of it is being gathered. Okay, moving to the next, So the second trend, first trend was technological, second trend was behavioral. And this is a conflicting trend because it really has to do with the attitudes of individuals about the data that's being collected about them. So the typical industry explanation for the collection of data is that people are willingly trading data for free services. For example, Facebook or Google or those kinds of things, and people are giving up their data so that they can get those services. In fact, the reality is much more complex. And people, for the most part, what surveys show is that people really don't like the idea of giving up their data. They would rather not do it. They feel that it's essential because these kinds of services have become so important to our lives that we can't really do it. It seems like we can't do without them. And so people feel resigned to giving up their data rather than truly accepting it. And even if this reality is complicated because it depends upon what kind of data and how it's being collected. So what this chart shows on this slide is the different ways that data can be collected. So people have less concern, for example, about self-reported data when you add your email into a store or something like that. And they have less concern if the company is simply using it to improve the quality of the service. So those things raise lower concerns. What really starts to raise greater concerns for people is, number one, data that is shared with a third party, and the way that your data is sold for marketing purposes is a strong concern. And the second kind of concern is what they call profiling data. Profiling data is when the data that they collect about you enables them to make conclusions about you. And so, for example, Target seems to know a woman is pregnant before her family and friends do, simply by her shopping patterns. So that's something. They can also tell your ethnic background, your age, your political viewpoints, all sorts of things like that about you from the kinds of Facebook posts that you like. So these sorts of things raise a lot of concerns for people. People don't like the idea that companies know so much about them. And so those kinds of things, when combined with selling that information to third parties, really raises concern for people much more so than the volunteered information. Okay. Next slide. And so as this sort of thing has become more and more known, we're seeing a decline in the trust in technology companies. And I think, we can all agree that it's really important for these companies to have the trust of their users to keep using the service. And even from June 2017 to January 2018, before a lot of the more recent scandals like Cambridge Analytica came out, there was already a noticeable decline in the level of trust in various technology companies. It was consistent across the industry. We don't have more recent data at this point, but we can, guess that that decline has probably also continued. So the trust that people have in companies is very much a concern for the companies at this point. Okay, moving along. The third trend that I want to talk about is the regulatory trends. And so the idea of how governments are reacting to interest in data privacy. And what's happened is we've seen a divergent trend. And the divergent trend is, on the one hand, you have Europe, which has passed the General Data Protection Regulation, GDPR, which a lot of people have heard about, which strongly protects customer data for the customer, and it requires customers to opt in to sharing their data with companies. And the intent is really to provide the maximum amount of transparency and let consumers decide how their data is going to be used. Whether that will be effective or not remains to be seen. On the other hand, in the United States, there's been a much more, for the most part, there's been a much more laissez-faire approach. And so the U.S. Federal Trade Commission has adopted, number one, what they call a notice standard, which means that the use of data should be disclosed, and also a harm-based standard, which means that data gathering would not be prohibited unless there is some specific harm associated with it. So that's in contrast to the GDPR, which essentially sets blanket rules about the gathering of data, regardless of how it's going to be used. Now, so those are two different approaches which are quite divergent to managing data. And what's important is, because data is global, it flows across borders, it really can't be contained within one country. That divergence can create a challenge for management for the companies. And one other thing I'll say about the data regulation issue is that California has now adopted a standard that is much more similar to the GDPR standard, although it is more of an opt-out standard than an opt-in. Yet it still sides more on the side of data privacy than on the free flow of information. And so that will be another challenge for the United States to create a consistent regulatory standard. Okay, so next one. So then, having talked about these trends, technological, behavioral, and regulatory, I want to move to what does this mean for companies and what does it mean for investors. One thing that we determined in our research was that there's a tremendous amount of uncertainty, that all of these different factors kind of are in kind of conflict with each other, and it's not clear how these trends will play out in the future. And so as an investor, you sort of have to be ready for different scenarios. And we considered 4 scenarios based on 2 possible outcomes. One is whether regulation will be more stringent in terms of protecting data privacy, or it will be more laissez-faire in the future. And we believe that eventually there has to be either a global standard, if there is one that will be effective. And then the second will be the degree to which consumers will demand data privacy. And those 2 factors will determine which kinds of business models will prevail in the future. And so, depending on the scenario, we would want to look at, both the business model of the company as well as how that issue is being governed by the company. And I'll focus on one of the scenarios, which is the low regulation, low regulation, high demand for privacy. We think this is the most likely scenario because it seems that concerns about data privacy are growing, but at the same time, it's not clear that an effective regulatory regime to really restrict the flow of data has been devised at this point, at least in our opinion. And so in that situation, it is likely that there will be limited trust in the system, that individuals will be wanting more data privacy, but not be able to look to their governments to provide that for them. In that case, we believe that the most important thing is that they trust the companies that they do business with. Because in that case, that they will not want to do business with companies that will not protect their data privacy if they don't trust the regulatory system to do it for them. And so that's one possible outcome. And so as investors, you would want to know whether companies are trusted or not in terms of understanding the implications for your investment. Okay, moving on. Okay, the next thing we wanted to do. So we basically looked at two different things when we looked at the specific companies and their exposure to data privacy. One was the business model and how important data was to that business model. And the second was having to do with trust. So in regard to the business models and data exposure, we looked at three different things. First, we looked at how the data was being used, whether it was internal or external, in other words, selling to third parties. What kind of data did they gather? So did they gather only the data that was voluntarily given to them by the user, or were they going all the way to the profile data when they were making judgments about people based upon the data that they were gathering? And finally, they looked at the business dependency, whether or not it mattered a lot or a little bit. And so on the one hand, you can take a look at, let's say, a Twitter, which sells its data to third parties, which is highly dependent because that's essentially how they make money. And they use the data both internally and externally. And so, Twitter is very exposed to the issue of data privacy. It's very important for their business, and they're doing things that have triggered concerns among users in the past. So that's something that we believe Twitter should pay very close attention to. On the other hand, if you look at AT&T, the data is mostly internal, mostly to understand its own operations. Does a little bit of gathering of personal information, but does not depend that much on it. And so they would be less exposed to this issue and probably do better, relatively speaking, in an environment where the restrictions on the use of data were quite high, because they would not have a competitive disadvantage so much in that environment. Okay, turning to the next slide. Okay, and then what we did, so separately from that, we looked at the issue of trust and how much consumers and employees trusted each of these companies. So this slide shows the green would be high trust, yellow would be sort of average, and red would be low trust. And so it goes from Alphabet, which has very high levels of trust for both consumers and employees, down to Walmart, which has lower levels of trust for both. And so in a situation like the one I spoke about, where trust was key, you would be more confident with Alphabet in that situation. The last column on this also kind of shows our estimation of how exposed they are to the business model. So Alphabet is highly exposed, but also has the trust behind it. So that's one analysis. Going down to the bottom, Walmart has average exposure, but lower levels of trust. And so all of those things might go into an analysis of the companies in particular. Okay. Now, going finally to what investors can do specifically about this issue. And the reality is, at this point, the amount of data that we have on this issue is pretty limited. But we believe that there are a number of questions that investors can ask companies in terms of their governance to help understand how well this issue is being managed and how well positioned the company is for different scenarios depending on how things play out. So we created a series of questions which are in the report, and they essentially come down to three areas. The first is the company's governance structure set up to handle this situation? Do they have the right board members, management compensation? Is the business model deliberate in terms of understanding the uncertainties around data privacy? The second has to do with the stakeholder relationships and how well the company knows its stakeholders and how, especially how the stakeholders feel about them. So the relationships about consumer trust, what kind of employee feedback and whether they're using both internal and external sources for that. And then also, of course, if they've been targeted by regulators for any kind of breach of regulations or laws. And then finally, talking a bit more about transparency and dialogue. So whether there's disclosure, how are they collecting their data? You know, do they have strong controls in place? And then also, you know, when we find out the results, are they consistent with company values? So for example, we hear stories about fake news all the time, fake accounts. You know, obviously those kinds of things are not consistent with the values of, you know, Facebook, which has been targeted with these issues. How is the company managing situations when the outcome is not consistent with their values? It's also a very important question for companies. And then lastly, I want to talk about the second opportunity that you might have, which is to invest directly in data privacy. So this is the last slide. And there are a number of small companies which have started to come online that are there to, particularly to help companies manage data privacy regulations. So two are called Nymity and OneTrust. These are essentially smaller companies who exist, you know, to help companies manage compliance around this issue. There are fewer services for consumers who would like to protect their own data at this point. One is called Disconnect. It's a small private company. But the most important thing to understand is there's an expectation of pretty high growth in this area. So it's looking at, our research showed a CAGR of 11% between now and 2023. So that's pretty significant as more and more companies need to figure out how to manage this, and probably more consumers will as well. Now, again, I'll mention, we are not recommending any of these stocks. We don't have an opinion about them, but we wanted to make that possibility, you know, known as part of our report. So that's the end of my remarks. And what I'll do is I'll pass it over to John now, who will offer the IRC Institute perspective.
Thanks, John. Just a few quick remarks before we get to participant questions. We had commissioned this report about a month before Facebook Cambridge Analytica scandal broke, which resulted in a $100 billion market cap change virtually overnight. Now, Facebook has recouped some of that, but the indication of just how large an issue this is when you start reading about disconnect numbers at various social media is largely due to privacy concerns, is staggering. And yet we don't really have a good way to get our hands around it. The phrase that data is the new currency is hackneyed. It's used so much, but it's true. In our field, in investing, you've just seen Fidelity come out with 2 products that have 0 fee for investing. And the reason is because they get your data and they can cross-market to you and sell you other things. So in every field, data has become the currency, even in money management itself. And yet the value of that data is completely inadequately reflected in any traditional financial metric. So we felt it was incumbent upon investors to try to have some sort of framework that enables us to understand how companies are monetizing the data, which this does with what type of data it is, how they collect it, and how they monetize it or how they use it either internally or externally. And this provides, we think, not just a useful taxonomy, but a cross-referencing with the business model uses and the regulatory environments under which those business models would thrive or be retarded, so as to enable investors to start having a framework against which to start judging long-term tailwinds and headwinds for these companies. Next slide, please, Kelly. As John pointed out, there's really a fundamental disconnect in different parts of the world and internally in the United States among different advocacy groups as to who owns the data. Right now in Europe, the fundamental underlying thesis of GDPR is you own your own data. You have the right to be forgotten. You can ask people to wipe you from their records, all those things. In the US, it's the data is available, it's free, and it helps us create apps and devices and whole new companies which serve purposes. The problem with that, as John said, or the reality of that, perhaps it's not a problem, perhaps it's a benefit, is that our rules get made by spasmodic crises. As we don't have bright lines, there's a notice and problem. And all of a sudden, someone gets called before Congress and raises their right hand, and there's a new sort of ethic defined as to what can be used. And so I think that by understanding the types of data that are being gathered and their use cases, we can try to price the risk of some of these companies being in that sort of situation as per Facebook. Finally, and I appreciate John's last slide and the point, in every sort of difficult situation, investors understand there is opportunity. Right now, the opportunity for technological solutions to the data privacy situation are small, and I would restate what John said. This is not an endorsement or a negative reading on any particular stock or company. But generally, what technology gives, technology takes away and then fixes again. Generally, not always. But it is worth thinking about the fact that if, in fact, we are not going to have a holistic global regulatory solution to this, and at least in the short term, it does not appear we will, companies and individuals will try to take this into their own hands. Now, whether that is 1% of the company's individuals, 5%, 10%, 50%, or 100% is up in the air. That obviously will size the market. But as John points out, Cornerstone has estimated a fairly significant compound annual growth rate because these technological solutions are small and rapidly growing, and that might be an area of interest, and that might wind up alleviating some of the regulatory pressure, which would then create more demand for their own devices or programs, and round in what would be a circle that would benefit that nascent part of the industry. And with that, I would stop. I also, as Kelly said earlier, IRC Institute will be winding down at the end of the year and having a successor at the University of Delaware. Cornerstone has done a number of wonderful reports to us. Many of you, I think, will remember the retail report that was done on retail and automation. So I just wanted to take the opportunity to thank Cornerstone, and we can move on to questions. Thanks much.
Thanks, gentlemen. So we are now moving on to the Q&A portion of the webinar. So as a reminder, you have a question box on your control panel. Just type your question in, and I will read it out loud, and one of the Johns or both of the Johns will respond to that. Looks like we have a number in the queue, so I'll just start running through those. The first question, do you think that blockchain provides an opportunity for people to take greater control over their data? If so, how might that play out for consumers?
You know, everyone points to blockchain as the savior in waiting. In our field, there was recently a investment advisory committee meeting at the SEC about proxy processing. and there was much discussion about whether blockchain could solve some of the plumbing issues. Clearly, the advantage of blockchain is that it is distributed. No company is going to control it per se, and it's uneditable. But don't forget to be verified. Some identification needs to be there. Right now, blockchain is talked about much more than it's utilized. There are very few applications that still use blockchain right now. It may wind up being able to provide some privacy because there will not be a permissioning of a central authority which can then gather your information. But I strongly doubt that it is going to be the single magic bullet that stops or Amazon or Twitter from or Waze or anyone else who's gathering your digital exhaust from gathering it and monetizing it.
Yeah, I'll just add a quick thought here to what John said. I agree with everything that he said, and what I would also add is that it's important to remember with blockchain, there's a belief that you can this is a system that can work without trust, essentially, because that the trust in a sense has been automated. But in fact, what blockchain does is it shifts the burden of trust from a company to essentially to the programmers of the blockchain. And so, you know, if you're imagining that there's going to be an intermediary between you and the company that will protect your data, you're going to have to trust somebody, and that would either be using the blockchain technology or not. But it's really that trust factor that matters more, in my view, more than the specific technology. I think blockchain could be a technology that could be used. It may not be the only one, but ultimately, the real currency here is trust.
Thank you. So our next question, Google has just acknowledged that it is allowing apps to share data from Gmail accounts. Do you see this as a big risk for Alphabet?
Yeah, I mean, I think this is an area where, again, we come down to the issue of trust, and the question would be, do the folks who are using Gmail really know what is happening with their data? Did they volunteer to allow that to happen? And if Google is just now, telling you that, for the past 10 years it's been sharing your data, then that's a concern, especially given that Google and Alphabet, have a high degree of trust associated with them. And I would say the second order of concern would be around the whole system of data, again, because if folks, what's being acknowledged here is not only is Google gathering your data, and not only is it allowing other apps that you're using that you may not be aware of to use that data. So that's a second layer. And then third, that those apps may be sharing the data with parties that you don't even know about. And so there's sort of a quality of, that your data is suddenly becoming public property without your knowing it, that tends to erode trust in the system altogether. So I do think this is potentially another step towards diminishing trust in the system by consumers.
Thank you. Our next question, Amazon has just announced plans to open 3,000 fully automated stores. What impact will data privacy have on retail?
What I would say about that one is, what we did in our report was we tried to make it clear that a lot of different industries are going to be affected by this issue, and I think it tends to be people focused on social media companies or technology companies when they think about data privacy. But data privacy really has broad implications for a variety of industries, and that's why we chose to look at financial sector, credit cards, telecommunications, and so forth in the report. Retail is another, obviously, a whole other issue because, and if we look at sort of Amazon Go as as kind of an extreme example of this, the amount of data required to operate that store is quite significant, because as soon as you walk into an Amazon Go, everything that you do is being recorded and used by the store in order to provide the service, but obviously also to provide information to Amazon. And I think the fact that they have decided to roll it out to 3,000 stores around the country shows that what was a pilot project was successful enough so that they are imagining a much wider use of that. So data is critical to the success of that operation, and so it increases the connectedness of the society, but also the dependency. So I think it is quite significant for retail as it moves towards a more automated future.
Thank you. Our next question, do you have thoughts on how a financial institution can disclose what they are doing for data privacy for their consumers while still balancing the disclosure limitations imposed by internal legal departments?
So what I would suggest is there's a couple of different issues that we might think about. One is the issue of cybersecurity, and so and that essentially is that your data is not going to get into the hands of people who don't have a right to have it, and that's one issue. And I think those kinds of issues tends to be operational and compliance based, and that's a slightly different issue from data privacy. And what I would suggest is we have not seen companies disclose data privacy policies in a way that is specific enough to let folks be very comfortable in how their data is being used. So I think to start with, a financial services company really ought to focus on how it's governing the issue. And the report, as I mentioned, has a number of questions that investors should be interested in to better understand how the company is managing these issues. And so, for example, what is the board conversation like? How does management compensation take this into account, and so forth? So I think those kinds of governance questions would be a good start. And I also think, there are emerging standards. I wouldn't want to try to detail any of them, but I know the California data protection law details how companies should be transparent to consumers about how their data is being used. And so that also, whether or not you are bound by those rules, it may be a good start in terms of understanding what the expectations around transparency are becoming.
Thank you. Our next question, I can take this one. Are these slides available? These slides will be posted on the IRRC website on the research page for this report immediately after this webinar presentation, so you can download those there. We'll also post a replay of this webinar as well this afternoon. And just scanning through, it looks like that is all of our questions. So we thank all of you for your interest and your participation. Again, all the information is on our website. You can also check the Cornerstone website for information. If you have any follow-up questions, don't hesitate to reach out, and we'd be happy to answer any follow-up questions. So thank you again, and we hope you have a nice afternoon.